Recording in progress.
Ciao.
Right, let's try without the headphones. Can you hear me well? Okay, perfect. Thank you very much for telling me. I guess it was like related with the microphone and the headphones that I was using. If you can hear me now, that's great. If any one of you have any problem, please let me know. So, well, then I'll repeat. Thank you very much for joining. I guess if you received this invite, is because you sign up to our webinar series that we announced on LinkedIn and via mailing. As you know, it's going to be 8 weeks in which every Thursday at this time, from 3 to 4 p.m. In Central Europe, we will be giving these webinars in relation to topics related to startup finance. I guess that some of you guys will not be able to make it live for all of them, for example, or maybe you're interested in some. Don't worry, in the same website that you signed in, you can or you will be able to see our webinars that we already gave. So like if you look us up in 3 weeks, you will be able to see like the 3 first webinars in the website. also actually in our YouTube channel. So, well, first let me share my screen, and I'll tell you about the agenda for today. And yeah, all right. I guess now you should be seeing my screen. So the topic for today is how to prepare as the business plan of a startup in 1 hour. Obviously, we will like make simplifications, as you guys can understand. But I think when we gave this webinar in the past in Spanish, it was pretty successful, and I think it provides a good hint on how on what is essential on a startup business plan and why it is essential. So today, for the first 5 minutes, we'll do a quick introduction on ourselves, on the startup, on me and on the startup CFO, and then we will move on to this financial model in 1 hour with an Excel file that we'll be playing with, and then let's try to find some room at the end for questions, stories, examples, whatever. So I think we are now 31. I guess we are not like too many, such that please, if you have any doubt, any comment, whatever, please just like unmute yourself or write in the chat, or like use the Zoom function for raising hand or whatever. But like the more dialogue we make it, the better. And the objective is to make it as much interesting to you as possible. So, quick introduction on me. I'm Jaime. My background is in physics. Long ago, I studied physics between Madrid and Boston. Then I started a PhD in New York, and I always say that I started it because I never finished it. And then it's when I moved more into the corporate world. So I worked for McKinsey for about 2 years. And then after being a consultant in McKinsey, I got a call from the first startup I worked at, which was On Track. So I started working in 2 startups as a head of finance or CFO. And that's when I started having projects as freelance. So while I was working full time, but I had like some former colleagues, consultants, or former colleagues from my startups that were starting new projects. And they told me like, please lend me a hand. Or these investors asked me for a business plan and I have no idea how to do that. Or my investors need reporting, or I cannot handle like the financial management of my own startup, or I don't have time, which is the most common, to dedicate to running the finance part. So I started having projects as a freelance while I was an employee. At some point, I had too many projects. So I became full-time freelance, to put it that way. And at some point, I had too many projects. So I started like as a company with the startup CFO in the year 2020. So since then, at the startup CFO, what do? We do fractional CFO services for startups. So again, startups that have raised between 1 and 15 million, maybe, sometimes even before. They want us to prepare like their business plan, their monthly reporting, to take care of the administrative issues, to help in fundraising, which is also a very, very, very common scenario, and stuff like that. I always say, if you had a CFO, anything that like you would look to your right and say like, please, you take care of that. That's what we take care of. So most of the time we work like as a recurring service, again, for startups that are like seed, Series A, something like that. Many times we also help preparing for a funding round. In these situations, we prepare both the pitch deck, the financial model, and also like to help with the strategy of the round and to help find investors as well. So as CFOs, we have worked with over 75 early stage startups, including all our business lines, which also include like some other like legal, accounting and stuff. We have worked with over 108 so far. So we have been accumulated experience. By the way, we have worked with clients that are present in over 20 countries. And that's why we started having like more presence and more connections with the German ecosystem. And recently we decided to open our office in Berlin. So since the beginning of this year, we are also present in Berlin. So we have an office in Madrid and another one in Berlin. And so it's also growing. Last week we launched an event pretty successful with the startup with the Berlin startup community, and our goal would be to expand our footprint in Germany and obviously internationally in other countries as well. We have a YouTube channel. I think I opened up here. Yeah, we have a YouTube channel in which you can find, like, for example, a feedback or description on our services, past webinars in Spanish. This series of webinars, we will upload them as well, so they will be available in the YouTube channel. And also, as a new initiative, partly related to our internationalization, we are launching this series of webinars. So here in the website content.tsfo.com/finance course, you have like the list of webinars that we'll be giving with the dates and stuff. Once we complete one, you guys will have here the link to the video. So like at the end of the course, like the 8 videos, they should be here. We'll be covering topics of the next one is going to be like an outstanding pitch deck, very common, startup reporting, startup main business models, SaaS metrics. SaaS is the most common business model for startups. So I guess that that's like very useful and pretty successful as well. Cohort analysis, a really underrated topic. Lean startup method, focusing a little more on like the strategy and not just like the pure finance. And then more on financing again, revenue-based financing, which is like definitely growing. And this will be our last webinar in this series before the summer. So I guess what Danny just shared in the chat, the link to our YouTube channel in case you are interested. So let's get started. So first of all, why are we here? Why do we need a business plan even from day one in a startup? So it is true that like if you are an early stage startup, especially if you are a very early stage startup, you will think that your business plan will keep changing constantly. In fact, it should change constantly. Like a good startup never stops pivoting. And especially at the beginning, this pivoting is bigger than or more pronounced than in later stages. But even if it will keep changing constantly, you need to figure out how much to raise. So if you're in a pre-seed stage or even before, whatever, in the ideation phase, you need to figure out how much to raise. And that, obviously, a good number analysis will give you the hint and will give you an estimation. I think it's very important that at least like some numbers are like either done by yourself or like or you overlook as a potential CEO or as someone that is helping an early stage startup. So I think getting a hint of the numbers can like really land things down and realize what's important and what is. In relation to this, make sure that it can make sense as a business. This is crucial. So there may be like a great idea that covers, like a significant market, whatever, but if the cost will always outweigh the revenue, this cannot make sense. Or maybe your business model, the way you charge your clients for the product, is not the right one, or maybe your pricing is not the right one, and you will make sure of that when you play with it. Again, test different business models. Should we do like a subscription service? Should we do something more like an on-demand? Should we do like our clients pay by each API call that they do? Whatever, that's something you can test with numbers. Be prepared for investors, and this is very important. Investors will, especially in early stages, will not only judge the numbers by themselves to say like, is there a potential like a reasonable business model here, but also they are judging you. What does that mean? That if I open a file and I see that like it's completely unstructured, that the numbers don't make any sense, that the ambition of the founder is not big enough, that the benchmarks, like it doesn't adjust to any benchmark, whatever, I will start thinking that that founder doesn't really know what he's doing. And also, again, well, related to the second one, you should know the numbers of your own business. That sounds reasonable. So let's get started. Let's get to the chase. In order to create a business model first, a business plan or a financial model, first, we need to create a P&L. What does that mean? the profit and loss for the company. So here, what do you need to do? Like to create a profit and loss statement. First, the revenue. So here, you need to do like every single business model. You should try to make it into a P times Q, into a price times quantity scenario. So this looks easier and is easier in some models than in others, but in the end, we should like aim for that. Let's see this example. And again, I'm fully aware of the fact that it's a part of it is a simplification and part of it may work, but I hope that in any case, it gives you good ideas. So here we see, by the way, a financial model that we projected for 3 years. To be honest, already 3 years, like it's madness. It's a lot of time for a very early stage startup. So, but I think it's enough to say, like, what is our ambition? What is achievable, like in a reasonable time frame? What could be believable, to put it that way? So, so here, I'm sorry, yeah. So here again, we try to focus in price times quantity. So for example, let's imagine that this is a SaaS business, software business. By the way, Teofilo just asked, could we have a copy of this template? Yes, please. If you want a copy of this template, please send us an email to directly to me, to jaime@tscfo.com. So I just wrote I wrote it in jaime@tscfo.com. So here what we have is our revenue is composed by active users times the price. Imagine it's a SaaS business, a software business that, it's a monthly subscription. So here, let's analyze and let's try to model both parts separately. The price very often is something that we may start with like some discount. So for example, here I put that in the first 6 months, we're gonna put 500 euros. And then at some point, maybe we start giving it without discount. Okay. Also, by the way, this could be perfectly be something like this, that at the beginning, you don't expect any revenue. You expect it to start selling in month 7, for example, or something like that. Or you give the product for free until then. So there may be like many combinations. But something that is important is to show that your average ticket will grow in time. This, obviously, there are certain business models, especially B2C, in which it may not be the case. For example, and even in those situations, I guess. So Netflix or like Tinder or whatever expects like for you to pay like a very low fee for a very long time. Still, like softwares or that companies that are B2B, at the beginning, they will sell to tiny companies, SMEs, and at some point they want to start selling to a huge company. I don't know, like Procter and Gamble, let's say, or Microsoft, whatever. I'm making it up. But in any case, I put the two extremes. But in any case, at the beginning, you sell to tiny companies, and with time, you will start selling to bigger companies. So something that is reasonable would be like to put some average ticket of your product, and then consider that via upsells and via acquiring new clients, the average ticket will grow. This is pretty important. And again, investors will want to see that you want the average ticket to grow, and it does make sense. Okay. So, by the way, again, feel free to stop me at any. And for the active users that are paying, here could be like different options, but let's imagine a very simple model. Every month, you have like some active users that like come from the previous month, like here. Then some new users that you acquire, and then some users that you churn, that churn, which means that you lose them. All right. And this is like a very reasonable way to calculate it, to say like active users plus the new users plus, but it's a minus the users that you lose. Like for example, here, like we can see already the numbers. You start a month with 17 clients, -1 + 2, so it's 18. This is very important. And a couple of comments here. First, on the churn, it's useful to model it as a percentage of the active users. And depending on your business, but usually like you will probably find like benchmarks for your own business. So for example, a B2B SaaS, 3% per month would be like the upper limit that is accepted. Maybe in the first months you have like more than that. Maybe you keep having like 3% per month for a longer time, whatever, imagine. But then, it would be reasonable to say like I count on 3% churn, and at some point it will lower to 2, and 2% churn is okay. Of course, things need to make sense, and like you need to add common sense to this. If it's tiny tickets and if it's a B2C, your churn will be higher, and you probably will acquire more new users. If it's a B2B that it costs 1,000 per month, then probably you don't acquire those many users, but you don't lose those many users. And in terms of new users, maybe you start with 0 for a while, then you start like with 2, and you consider that you are going to have like 2 new users for like a long time, and then at some point you will start having like 3 more per month, 4, or whatever. So, and you probably are thinking like, all right, for the average ticket, I have like a good, more or less like a good feeling of like what I'm gonna offer. For the churn, you just mentioned that I just mentioned that 2-3% is a good benchmark, and maybe if my product is different, I can look it up online and find like a reasonable benchmark. But what about new users? And my suggestion would be like, so far, write something that sounds familiar to you, but later on in this exercise, we will find out if it's something that makes sense or it doesn't. So for example, maybe at the beginning you could have put like, let's do 2 per month forever, and then we'll see. Fine. Later on in the exercise, we will make sure that all these things make sense. Again, feel free to stop me at any time. I think the chat may be like the easiest option, but again, if you unmute or anything, that's completely fine. All right, so we just covered the very first part, which is obviously crucially important, the revenue. And there is another part that is also dependent on your own business and no one else's, which is the cost of goods sold, or cost of sales, that will give you the margin. And again, the margin can also be called net revenue, can also be called gross margin, can be like gross profit, whatever. And it's usually, or the best way to model it is a percentage of the revenue. So, for example, let's give an example in B2B SaaS. That would be this the situation we're analyzing right now. But then I will give like another example, like of a marketplace, for example, Uber. So, every single business on earth has like some cost related to each sale. So, for example, Netflix probably doesn't like increase their cost significantly if I sign up tomorrow, but they are paying servers. And yes, they have to pay much more in servers when they have like 100 million users than when they have 10,000 users. So they need to spend money in servers that it correlates, not necessarily directly, but it correlates with the amount of users they have. And probably, and I'm making it up completely, they have like some softwares like that for each time that someone like signs up, maybe they need to call this service, whatever, and they get charged. It's very, very often in SaaS companies, it may be like infrastructure and data, for example. Or it can be, if the ticket is small, it can be like credit card commissions. And those are usually between like 2 and 3% more or less. So here, I'm going to summarize later the do's and don'ts, but here it would be important to mention that if I see a business model without any cost of sales, that's already like some of like a red flag for me. It's like every single business has some cost of sales. If they claim that the ticket is €2 per user per month and they don't include the credit card commissions, they should. If, and the other way around, if the ticket is 10,000 per month and they put like credit card commissions, I know that like clients are not going to pay 10,000 per month with a credit card. So for me, like very common red flags would be not to have churn, not to project churn, and not to project any cost of sales separate. Also, in a completely different business, Uber, obviously, like they will model the revenue, but like the active users, the number of trips that each user makes, the average ticket of each trip, and then that gives us the revenue. But then the cost of sales is obviously what they pay to the driver. and that may be that they pay, making it up, 85% to the driver, minus the commission cost, minus infrastructure, so maybe they keep 10%. So, but every business needs to have it. And again, I wouldn't overcomplicate things unnecessarily. Usually a percentage of revenue makes sense. This is something where also benchmarks are helpful. I will summarize them later. But if a SaaS business is usually between 80 and 95%, a platform maybe like, or a marketplace, maybe 15%, 20%, something like that, and e-commerce maybe 50%, it may change a lot from business to business, but like if I see that a SaaS business, they claim 60% gross margin, I'm gonna ask. That doesn't necessarily mean that it's wrong, but I'm gonna ask. So the entrepreneur should be ready to answer that question. And then we get to the margin, which is simply like the revenue minus cost of sales, essentially. So we see SaaS company, 90%, that's risk. All right. So now it's obviously, by the way, this can be like more complicated than we just showed. Again, it's a simplification, especially in the users. So you may have like different tiers in pricing, a light, pro, and enterprise, for example. And each of them will have a different ticket, and each of them will have like a different acquisition and churn and stuff like that. You may structure your pricing around negotiation. So like each ticket may be very different. Still, you should try to like get some average. But the logic of like price times a number of users minus the cost of sales, you guys should have it in mind and segment it as much as possible. Now, the good news is that for the next part is way more uniform from startup to startup. What does that mean? That here now we get to the personal cost. The personal cost is usually, and again, don't worry, I'll write it later in a separate slide, is usually 80% of the fixed cost of a startup, which means that it needs to be accurate, it needs to be very detailed, it needs to make a lot of sense, because 80% of the money that you will spend of the fixed costs not related to the revenue are personal costs. So don't worry that much about other operating costs, because the big part, with some exceptions, the big part is going to be personal cost. And what does make sense, or like how to model this? We need to have a hiring plan, and we need to have their salaries. Okay. So here, well, first of all, I would structure it around 5 cost centers. Something that is there's a question. I'll try to prioritize it. What about in manufacturing models? Do you use their inventory in BP, or you always use percentage revenue instead of using inventory? Obviously, a manufacturing model is more complicated, but it depends. My answer will be depends on the stage and depends on the on how significant, how much will impact cash, the inventory management. If I'm just in like pure ideation phase and I'm gonna start small and I'm planning on asking for 2 million and my inventory will just be like 10,000 euros, imagine, then I wouldn't overcomplicate things unnecessarily here. If it will impact cash significantly, then yes, probably this part of cost of sales will have like, when I order this batch or whatever. I wouldn't, by the way, over worry at this stage with the accounting of it. Maybe the proper accounting is to put like the cost of sales in the same month that I'm selling the product, which is actually the correct way. But maybe like at this stage, I would care more of like, okay, if I'm gonna order like 50,000 euros in inventory in month 4, maybe I would put it here, and I don't think it's a very big mistake. Technically, it's a mistake. We're just trying to figure out things, and then once the business is up and running, once it is mature, obviously we will complicate this model and we will track this cash and this accounting in a lot of detail. So something important here is that it's not the same like a business plan to test your idea and to think it than a reporting that includes everything, or a forecast that like will read from your reporting and stuff like that. But yeah, certainly manufacturing models are slightly more complicated. So in relation to personnel, something that is a very big red flag is if people don't detail like the cost centers. Imagine that they write simply this personnel cost. And that to me means nothing. I want to know like what are you gonna spend your money on, and when are you planning on like kickstarting each department, and what are you willing to invest most in. So you need a hiring plan and the gross salaries. There are, by the way, a million ways of doing all this. Obviously, the previous parts and especially this part. I'm gonna give you a system that I think it works or it may work, but there are many, many equivalent systems. And to be honest, probably if you look up other templates, you will find something different. By the way, if you look up templates, please always use a template that is specific for startups, because a template of an SME doesn't make any sense for a startup. It will not include the things that like neither you nor investors will need. So here is our way to do it. So you write out like everyone you think you may need to hire in the next 3 years, and you assign the departments to them. Usually, by the way, these 5 departments work with 90% of the companies. Obviously, you could then obviously split them in sub-cost centers, or like you can have different names. Maybe instead of R&D, you write product, and separately developers, whatever, I don't mind. But I wouldn't overcomplicate things unnecessarily. So there's usually a department on operations, making things running, sales, which is converting leads to new customers, marketing, which is getting new leads, R&D. This can be split in product and tech many times, but essentially like who's working on developing your product, and admin, which is usually a CEO, finance, legal, HR, whatever. If you split in more cost centers, fine. But like these 5, and maybe there are sub splits, is usually fine. So here, for example, wrote like some people for customer service, a head of sales and account executives, and an SDR, a VP of marketing, someone in VR, someone like creating new leads, a CTO with some developers, and in there maybe senior, junior, and then like a CEO, a head of finance, HR, and office manager. This doesn't mean that you're hiring all of them simultaneously, of course. But here you may write this example. The CTO and the CEO, which are the co-founders, start from the very beginning. And you want to hire in month 2 a head of sales and an SDR. This is a little exaggerated. Usually things would go like slower. So here you start hiring like in month 3, like some developers in time, whatever. And here you would write their annual gross salary. So this would be my advice. Annual gross salary is a figure which is easier to read and which is easier to think profiles with it. So in my mind, it's like I need a developer, which is probably like gross salary of a senior developer, probably like 80,000 per year in gross salary. So I would write the 80,000 here, but then up here in the formulas, I would add 2 things. It's like, okay, add up everyone that is in the R&D department, annual gross salary, divided by 12, because now it's going to be monthly, and then add the social security cost, which is crucially important because, for example, in Spain it's 32%, in Germany it's around 30% as well. And again, if personal cost is 80% of your fixed cost, please don't forget social security, because it's a huge increase on for example, also a rookie mistake, in my opinion, is to put salaries that are too low, which, by the way, in this example, it may be. Obviously, it's more an academic example. But for example, here, maybe the CEO and the CTO start making like relatively little money, less than they would make in the market. But then we see that after like a funding round, the CTO and maybe as well the CEO, for example, that they would raise their salary after a year to something like that is more believable in the market. And then maybe other salaries would grow or whatever. Also, but when hiring other positions, I've seen sometimes like people being like, you know, a VP of marketing for like 20,000 euros. And it's like, all right, but maybe he wouldn't be the best. He's probably willing to accept a salary reduction from his previous job. You will need to pay like with some equity, probably with some stock option. But if like everyone in the team is making between 10 and 20,000 per year, I'm not sure if you're hiring the best team. And by the way, later on, we will see how much we need. So let's first be like ambitious and realistic on what we need. Then let's see how much money we need to raise. And then we will make sure that everything adds up. And also, by the way, you're probably thinking like, okay, but what number should I write? What it makes sense? What makes sense here? Usually in a startup, like very soon, 40% of the personal cost goes to growth, which is sales and marketing. 40% goes to product development, product and R&D or IT, tech, developers, whatever. And the other 20% maybe operations. So I would like more or less try to balance the people that I'm hiring in growth and developers. Of course, again, there may be a lot of exceptions here. Maybe it's a company that they need to develop like a product, which is incredibly complex, deep tech. And then after a year, they will start thinking of hiring people in sales and marketing. Fine. Again, things need to be defendable. So like when I say any benchmark, of course, you can like go away from it. But if you do, be ready to answer the question and to make sure you know exactly why that's happening. And by the way, I think it's important to add like some headcount. So to know like in each moment, how many people in each department you would have. It helps to think like, okay, this is a company that in a year, they're planning to be 14 people, that in 2 years, they're planning to be 24, and in 3 years, they're planning to be 26. Again, for the longer term, don't worry that, but at least at the beginning, it gives you a hint. It also, a CEO should give you a hint of, okay, it's reasonable. I'm going to raise this funding round to get in a year 14 people working, for example. And I think on personnel cost, I think this is more or less it. Again, the fact that this we already explained the structure more or less and like some hints doesn't mean that you shouldn't spend a lot of time here, making sure that things make sense and making sure that you calculate the most important thing when estimating how much to raise. I'll hide that and just leave it like very beautifully, like the total personal cost over here with the subdivision in cost center. Again, feel free to cut me at any time. And then we have the operating costs, which are the costs that are not fixed costs. That are fixed costs, and that are not personal costs. So here, my strongest advice is don't overcomplicate. I would like use the same cost center structure that you use up there, and I would create a very similar structure down here, hidden, that says like, how much money I'm gonna spend in sales in month 4, for example. And if that's up, it's separating. Maybe some of your costs depend on other things. Zendesk, each license is gonna cost me 100 euros per month per customer service person. All right, so then you multiply how many people are you gonna have in customer service times the 100 euros, for example. Here, well, but again, don't overcomplicate this. To me, again, like what is gonna move the needle is the personal cost by far. And down here, to me, like the most important is like, is this guy like too naive to underestimate this? But I'm not gonna look up exactly like how much you're gonna spend in each thing, and I don't really care. My only thing is that this is super common among almost all startups, which is that 80% of the fixed cost is personal cost and 20% is operating cost. So then if I see roughly 50 and 12, then I'm like, okay, this is more or less like 20% fee. Fine. But like many people like don't spend too much time in personal cost or don't think too much if they're hiring like 2 or 4 developers, but they spend a lot of time thinking whether like in like in Slack they're gonna spend 13 euros per month or 14. So the biggest chunk is personal cost. Operating cost, my best advice would be don't spend too much time on it, but adjust to standards. There's only one exception here. In businesses that are very intensive in B2C, that are very intensive in marketing, then yes, then the budget for marketing may be huge, may completely destroy our 80-20 rule, because you heavily depend on marketing operating cost for acquisition. So that it could change things. And again, it's an exception that is reasonable, that you guys could explain, and that therefore it's fine. But it's an important exception. All right, so we just wrote up a lot of numbers over here, but we are like, does any of these make sense? Because so far we could have put here 20 new users per month, and you know, the Excel file didn't break just because I wrote this. I could have written here like 10,000 euros average ticket, and then again, the Excel file works smoothly. I could have put, you know, like we achieve this with 14 people like now, or with 140 people. Everything makes sense. So, well, sorry, everything adds up and like doesn't get broken. So how do we know that we are making some sense here? Well, the EBITDA, many times, like when the company is a little stable, it's very common that it's around minus 100%. This, like in Series A, it's pretty common. If I open up a first reporting of one of our clients, and I see that they have like minus 100%, I'm like, check many times. But this was for the P&L, and let's remember, like, some standards, revenue is usually low compared to cost. This is a real client of us, by the way. Gross margin varies a lot depending on business model, but for SaaS, over 80%. Platforms, this may be pessimistic, maybe less than 20%. Physical products, around 50%. Personal cost is 80%, and the split 40% for growth, 40% for tech. And operating cost, 20% of fixed cost, unless it's a B2C, and maybe then marketing destroys. And then minus 100% for adjusted EBITDA is very common. And again, well, in this stage, you shouldn't worry about what's below adjusted EBITDA. So like that's there. And anything may be different to these percentages, but if it is, you need to know why. There are also some other rules that, like, well, the minus 100% EBITDA already mentioned it, that may be good, like reality checks. Well, reality checks are like, what do investors want to see? Many times investors will want to see growth that is called T2D3, triple for 2 years and double for 3 years. So if your MRR, if your monthly revenue at the end of month 12 is 21,000, month 24 is 77. Okay, you more than tripled, you almost quadrupled. It kind of makes sense as an ambitious growth that could be achievable. And from month 24 to month 36, almost triple, again, it may be reasonable. If you say, like, every year I'm gonna grow 100 times over the last one, that's not believable. If you say we're gonna grow only 10% per year, that's not attractive for a startup. So this, like, T2D3 growth is very common. And also a trade-off for like growth and EBITDA, rule of 40. So your annual growth plus your annual EBITDA margin should be 40 or higher. If you are growing a lot, you multiply, you grow 200% per year, you're allowed to have cost of minus 160%, for example. And if you're growing just 100%, then maybe you can lose only 60%. These, again, very general rules. And I guess at your stage, I wouldn't over worry. Maybe I would with the revenue. So do's and don'ts. Keep a very consistent and ordered structure. Again, they are judging you as well. Segment revenue as much as possible and count and churn. Big red flag for me if they don't. Include cost of sales. Add social security cost. Many people forget it, and it's a huge part of your biggest expense. Don't overthink operating cost, and adjust to industry standards. And I could say, and if you don't, say when. So again, well, you can stop me for any questions. I think maybe we go a little longer than 4, but it shouldn't be too much. So how do we go to cash flow the easy way? And again, I would do here like a very, 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 very simple exercise. I would just add here like the cash injections that I'm expecting. And then here just like, you know, cash of the previous month, plus the EBITDA of this month, plus any funding round I may have had. So at the beginning, if you compile this, you will see, like, you know, to survive the first year, I will need which is like advisable, by the way, for a seed round, maybe to try to survive for like 12 to 18 months. Maybe you say like, let's raise 400,000. And then you see that you would run out of money up here. So then maybe you model again, like for the future, and you see like how much money you will need. Maybe you decide that you would be able to raise more money. So you say like, let's raise 2 million. And therefore you decide to change your hiring plan from that month onwards. So essentially, like, let's make this into cash. But let's be reasonable with how much cash we are asking now, how much cash we will ask in the future with what our plans are. If this were the situation, for example, I would like grow the hiring plan and the salaries from that month onwards, for example. I will not stop like so much here because you will see like in the end how much like all this iterates. But I will just mention that obviously this is like a very big simplification. But again, if you are just starting or like a very early stage, this is probably fine. What complicates cash? Collections and payments delay. Many times, like you collect like a couple of months later or 1 month later, and payments, maybe you do them like 1 month delay. Taxes, obviously. Annual contracts, which is very common in SaaS, you charge for the whole year, even if your revenue then is month after month, and stuff like that. So if those things are significant at your stage, then yes, I would play with them in the Excel file and complicate it a little bit. Otherwise, I think like with this quick solution can be. So as for enough to survive for 12, 18 months, if you're in later stages, 18, 24, especially now, count on future funding rounds and model the P&L accordingly. Be realistic with the amount you can raise. You know, maybe your model is super fine, but if you need 10 million for the first year, then something's off. And be realistic with the valuation you can achieve in a future round. Also think like, with these figures up here, could I raise 2 million? And then you should think, and there are benchmarks that will show you that actually probably not, if this were the situation. And so you will see why like it's difficult. Like, you know, it's easy to build the Excel file. It's difficult to make it all make sense. Why is this? Again, why didn't we write like 10 times more sales or 10 times less? You know, the Excel file doesn't break if I put like 20 new users per month. Will investors believe it? Do I actually believe it? Like that we will be able to do all this revenue and all these users with this spending and with this investment in personnel and in operating costs? Do I believe it? Is it possible? This business model that is this financial model that is very general, is it the same like for a company that sells cars than for Netflix? You know, that are completely different models. So like, again, there's like an Excel file, I can write anything, but like, does it work in any business model? And related to this, we will understand why do venture capital firms invest in big chunks and every time like increasing in size. So why is all this, and why did we start to make like to have this argument? Because of the concept of unit economics. So every single business, every single investment on earth like follows the system of like an initial investment that you have like the goal of having some return afterwards that compensated, pays off, and you have something. So here we would see like the typical, you imagine that you are Uber and you decide to open in a new city. So at the beginning you will lose money and you will hire people, and that, you know, and that you will probably subsidize the trips and like put like very aggressive marketing campaigns, and you lose a lot of money. At some point, you know, you start like having like some trips and some profit that compensates part of the cost, and at some point the city is nor losing nor gaining any money. Then it starts making money, and at some point it pays off like the previous loss, and after that is pure profit. This makes a lot of sense, but this needs to be included in the financial model to make sure that everything makes sense. And this is crucial. So in every single business, you have like a customer acquisition cost, the CAC. What does that mean? That directly or indirectly, acquiring a client costs money. You have a department of sales and a department of marketing because you want to acquire new clients. So if you spend 10,000 euros and you acquire 10 new clients in that month, each new client costs you 1,000 euros. That's it. maybe a little more complicated if there's some delay, but essentially this is like the very quick calculation that we can. And then you expect the client to pay itself off during its lifetime, which means that Netflix acquired me very long ago, like 7 years ago, probably. And for 7 years I've been paying like my 15 euros per month or whatever. So in time, I've provided them with a very, very large, well, relatively to my acquisition cost, a relatively large lifetime value with Netflix. And by the way, this is not the revenue only, but the margin that they keep, which is a little less for sure. And at some point I paid back, my cost. So all this gets to some metrics that are incredibly interesting, which is especially the LTV over CAC. So a venture capital firm expects that the payback is in less than 12 months. Then in less than 12 months, in my example, Netflix would have recovered the cost of acquiring me. And even more important, that my lifetime value is more than 3 times my acquisition cost. This is crucial and this is very interesting because this applies to every single business owners. Maria is asking me, are you sharing the presentation? Yes, well, you will have it in YouTube and you will have it also in the website where you sign up for this webinar series. You will have the video, so you can take a look at that later. So every single business, it has like some correlation between lifetime value and acquisition cost. And that's why I put like but realistic. What does that mean? If you're selling SAP licenses, SAP, like the huge SAP, the huge ERP system, like every single huge corporate in the world uses, the licenses are literally millions of euros per year. And it usually lasts for like many, many years. To sell one of those contracts, you're going to need several salesmen working on it, a huge percent of their time, preparing proposals, chasing them, like I don't know, maybe literally 25 meetings with different departments to then like readjust the proposal and the budget and so on. So maybe like one salesman signs, I'm making it up, but maybe like 2 months, two contracts like that in the year. And they spent a lot of money, like the junior team, marketing, proposals, materials, traveling, and stuff like that. So if you're selling contracts that are huge and that they will last a very long time, your acquisition cost is going to be very high. It is absolutely impossible to sell licenses like that, that an intern is going to sell 10 per month, therefore making your lifetime over CAC of literally hundreds. That's impossible. On the other hand, let's go to the opposite side. Again, with Netflix or with Tinder or with whatever, maybe my lifetime value is small because I'm going to stay with the client only for a few months and I'm going to pay like a relatively low amount, like 5 euros. But that correlates with a very low acquisition cost. Maybe it's very viral. They didn't need to make a specific effort on me. Maybe, once a big network exists, the next users are almost free, but then my lifetime value is going to be very low. Every single business on earth needs to be like profitable here, like above 3 is good. But over 10, to me, is already like, I don't believe this, or it's difficult for me to believe it. 10, 15, maybe. So now we'll see how this ties up with the model that we were seeing. So how do we do like an LTV CAC analysis? So we calculate the LTV and the CAC, obviously. The lifetime value of the client is simply a client pays me, according to what I put up there, 500 per month, with a gross margin of 90%. So I keep 450 euros per month. The churn, I put 3%. So if I put 3%, and this is simple mathematics, then the average lifetime would be 33 months. Some of my clients will stay longer, some of my clients will stay short. But the average client will last 33 months. For example, let's see an example where it's more mature. In month 13, the ticket is much higher, the margin is the same, the lifetime is 50 months. So a client within its lifetime, again, the average client would pay almost 90,000 euros in margin, would bring me a gross margin of 90,000 euros. And for the acquisition cost, in this month, including all costs in sales and marketing, both personal and operating costs, I spent 45,000. No, I expect to spend 45,000 to acquire 4 new accounts. So that makes a CAC of 11,000. So the proportion of the two is an 8. And it will be very good, but still healthy and believable. So this is what ultimately ties things with here. So you should take into account the benchmarks. Again, that, we are not making like anything too crazy over here. Our average ticket grows. We count on churn that is reasonable. We have some cost of sales. We spend our money in growth and tech, a reasonable operating cost, so on. But then this is what it like answers the question of like, if I had written 20 new users per month, then I go to the unit economics, and then I see that I have like an unrealistic business, because it's impossible. You are not the first guy on earth that is able to sell like such a good business that is going to bring you so much margin with so little cost. So if you had started your, obviously this is an exercise, and I already did this before, and that is tricky. So that's why the numbers were looked reasonable before. But if you had started writing at 20 and you get here, then something's off. Either you need to add cost in sales and marketing, a lot, by the way, or you should lower your expectations over here. Well, actually, I'll return to here. So this is like very, very, very important. So for example, with the numbers we just wrote, at the beginning, it's less than 3. I don't really care. It's the very first months, and it makes sense that you're overspending in the first people in sales and marketing and stuff. Then it's like reasonably healthy, and then at some point it gets too high or suspiciously high. So here, probably, if this model was for real, I would start adding like a couple of more salesmen from this month. But you see, and this is like where it gets tricky, and where the title of this presentation is tricky as well. Like if you want to create a good business plan, it will take you longer than another, because at some point you realize unit economics are too good. You have different options here, maybe to lower your revenues or to increase your spending in marketing. For example, if you decided to lower your revenues, maybe now the growth is not attractive, or maybe now, like, in the end, you're saying that in 3 years you're going to be making like 5,000 per month, which is bad. So maybe you decide to increase the cost. If you do increase the marketing spending, then maybe you have like too many operating costs, which you knew that's like off benchmark and therefore probably will not happen. So you decide to increase personal cost as well. You do that, and then you realize that the 400,000 will not allow you to survive for a year. So then, like, you improve a little the revenues, but then you realize that the unit economics are too good, for example. Obviously, that's one combination of like many, many others you could make. But at the beginning, imagine you had started here, I'm going to exaggerate it, with like, without all this thing, whatever. So then, like, you would realize, okay, I need more people to be believable, because otherwise, like, benchmarks don't adjust the standard, especially unit economics don't make sense. So to make all this make sense is really, really, really iterative. Okay, so it will take very long time to do it right. Do's and don'ts with unit economics. First of all, calculate them, unit economics. If you don't, then the VC fund will do it. And maybe the VC fund will do it, and maybe they find that are terrible unit economics. And they will get back to you and say, like, there's no business here. Or they will be too optimistic. So therefore, they will say, like, we don't believe this. You will need to spend much, much more. So I'm not going to give you 500,000 now because you need 3 times that amount. Don't be too optimistic. It's very unlikely that you created the first model on Earth whose LTV/CAC is huge. And make sure that you explain your unit economics well in your business deck. There should be a slide that says, like, this is like the unit that I want to recreate. That unit can be a city in the case of Uber. That unit can be a client. That unit can be an object. Imagine, for example, the car sharing or the scooter sharing startups. But make sure that you see, like, this unit is going to be profitable, and I will be able to replicate it in times. And that's why the investor will say, like, I believe this, so I'll give you a lot of money so you create many of these units. Questions, stories, examples, whatever. I'm free to like spend a little more time. It's just 4 actually, but I'll be happy like to jump back to open the Excel file again. To you know, if you have like a story that you think that will be insightful for the rest of the attendance, whatever, feel free to ask. If not, then we move on. Feel free to write us at any time, either at my own email, jaime@tscfo.com, either at Danny's email, which I think is the one that you received the invite from, sales@tscfo.com, in the website, whatever. So this webinar series will continue next Thursday with how to prepare an outstanding pitch deck in 1 hour. It should be like more or less like the B side of this webinar. Part of what you need is the financial model, and of course, you also need an outstanding pitch deck to convince investors. Again, the webinars are completely free. We encourage you to share the link where you signed up, or like if you want to invite people to the calendar events. You don't need to attend all of them, absolutely. Maybe you have to attend like the ones that you are more interested. Feel free to share them. If you are in a venture capital firm, feel free to share it with your portfolio companies. Whatever. The more the better, the more the merrier. And if you want us to help you with your VP or your pitch deck, of course, we'll be here to help. So thank you very much. This was the very first one. We have 7 more to go. So I really hope it was useful. Thank you for your comments in the chat, and hope to see you soon next week. So see you. Thank you very much.